In this strategy, we examine the market's history to pinpoint crucial support or resistance levels. These areas represent points where the price has historically encountered obstacles when attempting to move through. In the meantime, we need to closely monitor any sudden break of this level, both upward and downward. These movements should coincide with the formation of relatively large candles characterized by substantial bodies and minimal wicks. After this, the market will likely enter a phase of consolidation or range, which could last for some time. However, it's crucial to avoid entering long or short trades until the market achieves stability near the breakout point. This could mean waiting it out until you see any signs of a reversal around that area. While using this strategy, closely observing the price action in that area can offer significant advantages. For instance, in this scenario, following an extended downtrend, the emergence of higher highs and higher lows could signal a definite reversal and the beginning of a bullish trend. Or, for those of you with a keen eye, spotting the formation of this bullish QM pattern can be another reliable sign of a potential reversal. Another essential aspect to consider when employing this strategy is that when there's a pronounced shift in market sentiment, it often leads to a prolonged trading range. Consequently, it's advisable not to set unrealistic targets for your trades. Opting for noticeable support or resistance levels from the past, or even liquidity zones as potential take-profit levels, might be a more realistic and viable choice. Moreover, keeping an eye on various technical analysis elements could prove beneficial. For instance, incorporating a trend line that aligns with the breakout point can significantly enhance your trading strategy. We all know that Bitcoin trades round the clock, but the CME futures market operates on a different schedule. When the market closes on Friday and reopens late Sunday or early Monday, a gap emerges, reflecting the difference in prices. Some traders view CME gaps as potential indicators, expecting them to eventually be filled since the market often revisits these levels. However, CME gaps offer trading opportunities beyond simply filling the gap. Often these gaps prompt the market to enter a prolonged consolidation phase. This offers traders who prefer range-bound markets the chance to establish multiple buy and sell trades around the boundaries of these ranges, especially in lower time frames. They utilize the opposite side of the range as their potential targets. While the filling of CME gaps is quite common, it's not a hard and fast rule. Some gaps, like one that occurred in March, may remain unfilled. This prompts many traders to monitor that zone closely if the price ever reaches that area in the future. Also, it is possible for these gaps to occur on days other than weekends. When such gaps arise between consecutive weekdays, I usually avoid looking for trading opportunities unless the gap is significant. Here, we can observe a gap between Monday's closing price and Tuesday's opening price. Due to the gap's significance, a trading range has emerged, potentially offering reliable buy and sell signals. Similarly, here we see the same occurrence caused by a substantial gap between Thursday and Friday. After a consolidation phase, the price swiftly moved toward the gap, marked by the formation of a sizable bullish candle. Most traders see a break in a trend line as a sign that market sentiment might change, so they instinctively prepare for that shift. But it's imperative to realize that while this approach is common, it doesn't always guarantee reliability. Trend lines can be manipulated, and from what I've seen, this happens quite often. Sometimes these trend lines appear to break on one side, but after a brief pause, the price action reverses its course and continues following the trajectory of the previous trend line. You might think we can always trade these trendline manipulations, but in reality, we need more confirmation to steer clear of falling into another trap, something we'll delve into in the following strategy. The third strategy harnesses the power of a trend line in a higher time frame, when the price retraces back to it, by forming a reversal pattern in the lower time frame. Let me paint a clearer picture with an example. Here the pair's price has declined steadily on the 4-hour chart. Using these three fractals, we draw a trend line and patiently observe how the price behaves as it nears this line for the 4th time. Upon reaching the trend line, the shrinking candles pattern clearly indicates momentum loss in this time frame. But as I mentioned before, we want additional confirmations from lower time frames when the price gets near the trend line. When we shift to the 15-minute chart, we notice the initial signs of a potential reversal as the price enters a wedge pattern. This pattern holds significant weight in terms of reliability, as I've frequently highlighted its strength in several of my videos. By merging these two solid clues from different time frames, our inclination strongly favors the selling side. If you'd like to enhance your analysis, consider adding the RSI indicator to your chart. Pay particular attention to any divergence between the price and the indicator, which is distinctly noticeable in this situation. Taking a look from the perspective of less experienced traders, they could misinterpret the trendline break as a signal to initiate a long position, assuming the previous trend will persist. But those who have a bigger picture of the market in mind await the wedge pattern to break downward before initiating a sell trade. In my experience, trends following this occurrence tend to be extensive and offer traders favorable reward-to-risk ratios. So, from now on, whenever you notice the price nearing a trend line, consider shifting to a lower time frame to check if a reversal pattern is potentially unfolding. This holds true even when it appears that the trend line has been broken. The next strategy proves helpful when the price is trending above or below a specific trend line and then suddenly surges, creating significant distance from that trend line. After a few minor swings, it promptly retraces back to the trend line in just one leg. In this scenario, we're not necessarily anticipating a significant trend reversal. Our goal is more focused on seizing the second leg of the pullback before others catch on and before the opportunity closes. To initiate a short trade in a bearish scenario, it's essential to spot a pin bar and confirm it with a subsequent bearish candle close to the trend line. Yet, a more cautious approach involves waiting for the price to break the trend line and then pulling back to it. It's imperative to bear in mind that fulfilling these conditions is necessary when employing this strategy. Sometimes, despite everything seeming aligned for an order based on this strategy, the subsequent requirements might not unfold, causing the price to persist in following the trend line's direction. The second leg of the major pullback doesn't always match the length of the first one. Sometimes it is longer or shorter. However, in my experience, it's rarely shorter than 0.618 times the length of the first leg. Remember, the way the price approaches the trend line holds great significance. In this example, you'll notice that rather than swiftly retracing to the trend line in one leg, the price reaches it in two legs with considerable compression. In this scenario, unlike the prior one, we typically expect the price to bounce back from the trend line and resume its previous trajectory. I often focus on the 20 exponential moving average because it's widely embraced by both institutional and retail investors. Among technical analysts, it holds popularity as a dependable indicator of market trends. However, solely relying on the 20 EMA might not yield significant profitability. To create a successful trading strategy, it's essential to incorporate proven elements from price action. One of the most powerful additions to complement the 20 EMA is a specific type of trading range, referred to as barb wire. This particular price action is characterized by an extremely tight range or consolidation, often comprising numerous dojis and small candles with narrow bodies. Barb wires come in different shapes. Some have upward or downward angles, but the ones we prefer to use with the 20 EMA are mostly flat or horizontal. Before exploring this strategy, it's crucial to caution against trading within any barb wire formations. They are highly unpredictable and widely regarded as significant capital drainers in the realm of price action. Barb wires often appear near the 20 EMA and seem tightly connected to that line, almost as if adhered to by an invisible force. The initial strategy I'll explain involves the price moving out of a narrow trading range, or barb wire, and retracing back to the 20 EMA. These pullbacks offer traders excellent breakout trading opportunities. However, it's crucial to be mindful of the market sentiment. To keep things simple, I focus solely on two primary factors: the price action preceding the barb wire formation and the general direction of the 20 EMA. In this case, prior to barb wire formation, there was a notable upward surge. Presently, the market appears to be in a recovery phase, resembling a triangle pattern. The price can break out of this consolidation and resume the prior bullish trend at any moment. According to the slope of the 20 EMA, there is no noticeable upward or downward trend. However, given our current consolidation phase, which appears to be nearing completion along with the repeated tests of the upper trend line resembling the pre-breakout structure, we are focusing on the triangle's breakout. After the price breaks out of the triangle boundaries, we seek trading opportunities when the price retraces to the 20 EMA. You can place a limit order at the 20 EMA, or if you're more cautious, you can watch for rejections at that level. Finally, with the formation of this pin bar, we can enter a long position and set our stop loss below the pin bar's low. Given that this strategy is primarily designed for scalping or capturing small swings, it's crucial to exercise caution when determining our exit points and avoid setting unrealistic targets. This gains more significance when we observe these two consecutive pin bars. With this in mind, the triangle's inception could serve as a viable take-profit level. Barb wires are also notorious for false breakouts. In this example, the price broke out of a narrow trading range from below but swiftly reversed its direction, forming two solid bullish candles. However, considering the behavior of this pattern and the prior buying tendency, along with the bullish 20 EMA slope in that area, we may wait for a price recovery. Then we can seek potential long entries as the price bounces back and rejects the 20 EMA. Catching a pin bar on the 20 EMA signals a potential long entry, with the stop-loss order placed below that line. However, opting for the more secure strategy involves waiting for a second pullback to the EMA. Keep in mind, the market might not always present this second chance, resulting in a missed opportunity. For me, that's acceptable, as I always prioritize well-defined setups. When considering take profits, one option is to target previous market highs. Alternatively, by detecting a new rally, we may want to stay in the trade and look for potential reversal signals, such as the emergence of these two bearish pin bars. Here are a few examples showing how this strategy can also be effective in a bearish market. In the second strategy, the initial requirement is a swift price movement in one direction, typically characterized by consecutive large candles of the same color and devoid of substantial pauses. We commonly term these price action movements spikes, a topic extensively covered in another video available in the description. Following the price pullback to the 20 EMA, we look for any signs of price rejection around this line. After that, we await the second pullback to the 20 EMA, searching for trading opportunities as the second rejection becomes evident. Keep in mind that the second rejection from the moving average might not always hit the exact line spot on. Sometimes it might slightly overshoot or undershoot. But here's the deal. If there's significant deviation from the 20 EMA, it could signal a flawed trading setup that might not be worth the risk involved. When considering whether to take a long or sell position after the second pullback, I advise looking for reversal patterns in lower time frames for an ideal entry. This is because sometimes the second price rejection happens quickly, potentially causing a missed trading opportunity with a good reward to risk ratio. When it comes to finding the right spot to set the take profit, I usually turn to the Fibonacci extension tool on the toolbar. I measure the spike's length and aim to exit my trade somewhere between the 0.618 and 0.786 Fibonacci ratios. It's like finding that sweet spot where I think it's best to wrap up a trade. Here are some examples of this strategy in both bear and bull markets. Here's the third strategy, and it stands out from the previous ones. While the earlier strategies focused on riding trends, this one takes a different approach. It's a counter-trend strategy. When you observe market movements closely, you'll notice that they often hover near the 20 EMA. This consistent proximity to the 20 EMA is a key characteristic indicating a healthy trend. But there are occasions when the price deviates too far from the moving average. This situation can present traders with an opportunity to enter a counter-trend trade if they notice significant reversal signals, particularly in lower time frames. Taking a closer look at the price action, we sometimes see a pattern where small candles with ideally short shadows line up closely, forming a narrow channel. These candles are usually the same color, and they tend to either touch the trend line or come very close to it. These extremely tight channels, which we call microchannels, don't have any pullbacks within their bounds. Microchannels usually feature 3 to 10 candles. Personally, I've found that the ideal range often lies somewhere between those two thresholds. Some traders view microchannels as a sign of strength in a trend, but this isn't a strict rule. While it's true that consecutive microchannels can sometimes signal the start of a strong trend, in my experience they aren't particularly common in the markets. When they do occur, they're typically more useful for gaining insights into the market's structure than for providing a clear-cut trading strategy with precise entry and stop-loss points. Before we discuss strategies for trading microchannels, it's essential to remember that not all patterns that look like microchannels are actually tradeworthy. For instance, take a look at this pattern here. You'll notice that most candles have long wicks, and they resemble doji candles. This is a key signal that they're not really fit for being labeled as a microchannel. When trading this pattern, we typically scout for small price swings and stick to trades where the reward-to-risk ratio is no more than 1 to 1.5, even though this strategy was initially crafted for fast scalping on smaller time frames like the 5-minute chart. It's still quite practical on larger time frames, as long as we take into account all the factors we've talked about. Typically, there are 4 primary scenarios to consider when trading in a microchannel. The first scenario arises when the prevailing market trend is upwards, and the microchannel mirrors this trajectory with its own ascending slope. In scenarios like these, we focus solely on buying opportunities, aligning with the market's prevalent uptrend. However, identifying the market trend through simple observation can be quite subjective. It's interesting to note that various traders might have their own unique interpretations of the situation. Using long-period moving averages can indeed reduce the ambiguity in identifying market trends. The simple moving average with a period of 50 days is a common choice, as it smooths out price data over a significant time frame. When the price is above the 50 SMA and the microchannel is trending upwards, we aim to enter a long position only if a candle dips below the low of the candle before it. This strategy is based on the assumption that such a downward pullback is temporary and the market is likely to continue its upward journey soon. We then place our stop loss just below the low of this candle and set a take-profit target of either 1 or 1.5 times our initial risk. As we can observe, the market climbed significantly higher than our initial speculation. In light of this, adopting a 2-step approach to taking profits could potentially enhance our money management strategy in such scenarios. This method allows us to secure some gains while still allowing room for additional profit if the market continues to rise. In the second scenario, we again find the price comfortably above the 50 SMA, signaling an uptrend. However, this time the slope of the microchannel is downward. In this context, our strategy diverges from the previous one. Here, we aim to initiate a long position when a candle's high surpasses the high of its preceding candle. Remember that the candle that violates the order of the microchannel is better off being of the opposite color, which in this case is green. This is because this scenario incorporates some elements of a counter-trend strategy. In contexts such as these, the price movement following an exit from the microchannel can sometimes be quite substantial. You might see a second leg equal to the first one, which signifies exceptionally high momentum. If you have followed me thus far, you have probably guessed what bearish scenarios might entail. In the third scenario, where the price is below the 50 SMA indicating a downtrend, the slope of the microchannel aligns with the dominant trend. Therefore, we only consider short entries when a candle makes a high above the previous candle's high. Lastly, in a bearish trend with the microchannel sloping contrary to the trend, we should only enter short positions when a candle records a lower low than its predecessor. The strategy known as pre-breakout accumulation stands strong on its own. That said, it also plays a key role in reinforcing various other price action strategies, significantly boosting their potential for success. Take a look here. You'll notice that the gold price picked up its prior uptrend after a significant pullback. But then, out of the blue, its ascent pauses, and it settles into a consolidation phase. It's as if gold took a breather before deciding on its next move. Let's zoom in on the price action near that resistance zone. Upon its first encounter, the price distinctly pulls away, leaving behind a long wick, a clear sign of rejection. However, with subsequent approaches, this pushback lessens. Eventually, we observe a series of weak candles queuing up just beneath the resistance, hinting at waning selling pressure. It's almost as if the market is hesitating, building up suspense before the next big price move. Furthermore, it's quite interesting to see that despite its efforts, the price just can't seem to break through that bullish trend line. It doesn't even dip below the low of the last significant swing low in the market. Now, this stubbornness shapes up into what we call an ascending triangle. This is a pretty solid sign that things might keep climbing. This pattern is like a green light, telling us that all the pre-breakout buildup is checking out the right boxes. After the breakout occurs, we typically expect a significant candlestick break above the resistance zone. Traditionally, we would then look for a pullback to the breakout level as an opportunity to enter the trade. However, in scenarios with pronounced price momentum, like this one, the market may not offer a second chance. We can often predict this intense momentum if we observe a large candle with a long lower shadow and minimal or no upper shadow. Occasionally, you'll see a surge of green candles on the chart, suggesting that the price has just made it past a resistance zone. When traders spot this, it often boosts their confidence to go ahead with a breakout strategy. Often, these traders will set their stop losses just a bit below this resistance zone, believing they've allowed enough buffer. However, smart money know that these common stop-loss placements are not strategically positioned. They lack adequate cover below a significant swing low. The smart money may then aggressively push the price down beneath the resistance zone to target liquidity zones. This is usually where a cluster of stop-loss orders awaits. To avoid getting caught in this, a tip is not to set your stop-loss too close to your entry point. Instead, a safer measure is to place your stop-loss below a major swing low. Also, keep an eye out for rebound signs below the resistance level. A clear sign of a significant liquidity zone hit is a robust rejection, like when a large bullish engulfing candle emerges, towering over many candles behind it. This could indicate that the market's pullback phase is almost over, and that the smart money might be getting ready to make a move. While supply and demand concepts can provide us with ways to spot these reversal zones on the chart, we're not diving deep into those today. However, other signals can also validate these areas. For instance, a divergence between the price movement and the RSI indicator can strengthen the case for a smart money entry. If you miss the initial opportunity, stay alert for a second chance. If the price approaches the trend line drawn through significant lows, it may be a good time to enter the market. So, while using this strategy, always think about these questions. Where are the bulk of stop losses set by other traders? Have they moved their stops to break even? Is there a clear rejection suggesting demand zone activity? Finally, once the smart money finishes accumulating, it often marks the beginning of a sustained upward trend. That's your cue to adjust your stop loss to a more favorable position, as the smart money's wash and rinse trick is likely to have played out. The Wyckoff method is a trading approach developed by Richard D. Wyckoff. It suggests that prices are driven by the intentions of large market movers or institutional traders. It follows a series of steps to recognize where these players are likely to drive the market. This method involves identifying distinct phases in price cycles, accumulation, markup, distribution, and markdown, to inform buying and selling decisions. In this video, we won't delve into the Wyckoff methodology due to its complexity, which isn't ideal for a brief YouTube video. Instead, we'll look at simple, clear strategies using candlestick patterns inspired by the methodology. In the first scenario, the market takes a breather following a significant move, entering a phase of consolidation. It's characterized by a series of overlapping candles reflecting a period where prices stabilize. The price then breaks through the support or resistance zone, but suddenly rejects it by forming an engulfing candle. This candle stands out as it covers a broader price range than the candles preceding it. On occasion, this candle may retrace the entire price movement before it. It might even close at a record low beyond the range of the previous candles. When trading with this strategy, it's beneficial to zoom in on a lower time frame to spot any possible divergence between the price and the indicator. Additionally, These smaller time frames are like getting a closer look under a microscope. This allows you to observe the intricate details of Wyckoff patterns, which are the backbone of this strategy. Drawing from this methodology, we're identifying a distribution pattern where smart money actively maneuvers to influence other traders. Moreover, keeping a keen eye on the trading volume in that vicinity can offer crucial clues about the pattern's potential success. Typically, you'd expect to see a spike in volume near the fake-out area. That kind of above-average activity can be quite telling. This pattern often indicates a strong reversal. Typically, the exit from this pattern happens with high momentum. As for take profits, we can use different approaches according to our strategies and trading styles. Personally, I find placing the take profit at the start of the impulsive move that triggered the price jump to be quite effective. Sometimes the smart money keeps pushing the highs until they gather enough liquidity to steer the market towards their desired direction. Take a look at this. We've seen this maneuvering occur twice now, and after the second long bearish engulfing candle, which nearly overshadowed all of its predecessors, we can conclude that the distribution phase has wrapped up, and we're now on our way to lower levels. Here, if we switch to a lower time frame, we can observe the actual distribution pattern unfolding. These forms of manipulation might also appear as continuation patterns. For example, when the price exits a distribution pattern on a higher time frame, it often enters another consolidation phase known as redistribution. In this phase, smart money may engage in the same type of behavior but on a smaller scale. This is the perfect opportunity for traders who missed out on the first rally to join the selling campaign. Similarly to the previous examples, cautious traders might keep an eye out for a second chance from the market. Take, for instance, the emergence of a double top pattern below the trading range. This could serve as the final heads-up, indicating the last place of supply. Sometimes, instead of an engulfing candle, you'll see a pin bar forming to reject a resistance level. Although pin bars are reliable as reversal indicators, remember they're not quite as strong as engulfing candles. In these cases, it's wise to wait for more price action to unfold. Maybe look for secondary entries the market might offer to catch the next wave of price movement. Major market players' interventions are not limited to bull markets. For instance, following a considerable downturn in Bitcoin's value, the market entered a phase known as accumulation, where institutional whales strategically gather more assets in anticipation of a potential price reversal. In this pattern, smart money tries to convince other traders that the current trend will continue, tempting them to join in on the sell-off. But what they're really aiming to do is collect enough liquidity from these traders to pivot the market's direction to their advantage. Here, after two attempts to push the price down, the appearance of a bullish engulfing candle with a long lower wick suggests that the smart money may have finished their strategic positioning and could be gearing up for a substantial market turnaround. When we take a closer look at a shorter time frame, like the daily chart, we notice a string of bullish green candles. This pattern indicates that the market may have reached its lowest point, or it's very close to that level. Those last efforts by savvy investors are often referred to as springs or shakeouts. These actions form the concluding parts of a complex strategy crafted by these significant market players. If you're seeking an early entry point, consider drawing a trend line, and once it's breached on a lower time frame, you might consider going long, aligning with the smart money's move. However, if you're a more conservative trader, you might opt to wait for a pullback. When you look at shorter time frames within an accumulation pattern, you often see a link. The price movements and volume phases tend to move together, showing a neat correlation. This harmony acts as extra confirmation that the accumulation pattern could be heading in the direction you're anticipating. Also, looking out for divergences between price and RSI indicator on shorter time frames, similar to how you do with a distribution pattern, can give you some great insights. These clues can help traders predict a market reversal before the crowd catches on. Finally, we can opt for the start of the market downturn as our primary take-profit level. Here you can observe a similar pattern forming on the Euro-USD pair. However, this formation emerged after a price surge, referred to as a reaccumulation. Once again, the diminishing momentum is evident, as the market makes candles with relatively long lower shadows, explicitly rejecting lower price levels. As we narrow our focus to a lower time frame, the reaccumulation pattern becomes clearer. Once more, the repeated testing of lows is apparent, resembling an accumulation phase. Similar to the prior scenario, identifying a trend line break within the pattern can indicate potential early buying opportunities. Reaccumulation typically indicates a continuation of price upward movement. To estimate a potential price target, consider that the distance covered by the leg exiting this pattern could be similar to the initial leg that entered the pattern. To achieve this, utilize the Fibonacci expansion tool from the toolbar and set your take profit target at the 100% level. Keep in mind the Wyckoff method encompasses far more than this brief overview, covering tons of intricacies. Make sure you research the system thoroughly if you want to maximize its benefits. Best of luck, and thank you for watching.